Welcome to Academic Gain Tutorials. In this video, we will look into the differences between private finance and public finance. When the optimization of finance is undertaken at a micro level, it is called private finance. So, private finance is the management and analysis of the financial activities of an individual, household, business enterprise, etc., which may cover savings, investments, insurance, banking, personal loans, tax management, credibility, fixed deposits, retirement planning, real estate planning and so forth. On the other hand, public finance refers to that part of finance which is related to the financial activities of the public authorities at different levels, that is, center, state and local, and the alternative ways to finance the expenditure of the government. It is also called as public sector economics, as the development of nations solely depends on it. So, let's look into the basic differences between private finance and public finance in a tabular form. Difference number 1. Public finance refers to that branch of finance which studies government financial dealings, including government spending, borrowing, deficits and taxation. On the flip side, by private finance, we mean the study and analysis of the income, expenditure, and debt of private individuals, firms and household. Number 2. In public finance, the government ascertains the total expenditure to be made on different sectors first and then identifies the sources from which the revenue can be generated to meet those expenses. On the other hand, in the case of private finance, any individual, household, or business enterprise decides the quantum of expenditure to be made, on the basis of his or her income. Number 3. The main objective of private finance is to manage the finance in such a way which helps in earning maximum profit, whereas, the primary objective of public finance is the welfare of the general public. Number 4. In private finance, the individual seeks to maintain a surplus budget by spending only a certain portion of his income. On the other hand, in public finance, the government usually frames a deficit budget during the phase of economic development, war or depression. Number 5. In private finance, the individual's income and his or her expenditure is his or her own affair, and so it can be kept secret. Conversely, in public finance, the government uses public money for providing public utility services. That is why it cannot be kept secret. Number 6. Public finance is related to the yearly budget of the government, which is fixed, but private finance is related to daily, weekly or monthly budget of an individual or household. And, difference number 7, public finance is relatively more elastic than private finance because an individual cannot make sudden and huge changes in his income, but the same is possible in case of public finance. In private finance, the individual or household can postpone or avoid certain expenses if they are unnecessary or avoidable. However, in the case of public finance, the government cannot avoid or delay certain expenditures, especially expenditure on defense, agriculture, research or public administration. So, these are the differences between private finance and public finance. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.